Wonderful audience, and thank you for joining the third day of the BCI Offshore Investment Managers webinar. Great to have you all with us again, and we thank you for your continued support. On screen now is the agenda for the day, and we will again cover a lot of ground on global macro, value, quality, this time global property and emerging markets. As you know, all the presentations and recordings of all 3 days will be shared on the Boutique Managers website, but we will also send out a thank you email with a link and prompting you to where to find those recordings. You're welcome to post questions in the Q&A bubble, and we will endeavor to cover all those questions, time allowing. While valuations remain attractive, global property has been stuck in neutral for the past 4 years. With low correlations to equity, it could be a good diversifier in portfolios, but where to from here? We do need to see something coming from global property. Kicking off a session today with global property, it is my pleasure to welcome a very familiar expert on global property, founder of Retway Global, Greg Rawlins. Good morning, Greg. How are you?
Good morning, Eugene, and thanks so much for the invite. And also welcome to all the viewers. My presentation heading, I borrowed it from the media. It's a little bit of financial and investment poetry. However, it does describe the position quite well in that for the last 4 years, it's been a very difficult time for property holders, but there's very good signs that there could be a fix in 26. So moving on to the poetry, to the reality, using in the words of NAREIT, which is the National Association of REITs in the US and represents the industry, and in their words, we are in a unique period with 2 valuation divergences, that between the broader stock market and REITs. And they go on to observe that despite strong operational performance and balance sheets, REITs have been stuck in neutral for the last 4 years. This dynamic has only been seen 3 times in the past, that being in the 1990s tech boom, when the market had an obsessive focus on what was then turned out to be the dot-com boom, and then again in 2008 in the global financial crisis, and in the early months of the pandemic where it recovered pretty well. So this current period of 4 years of underperformance is unprecedented over many, many decades that we find ourselves in. And here the NAREIT has been tracking the relative performance of REITs to the S&P 500 earnings. And as you can see, there's still a significant gap between, between the S&P valuation versus the REITs going back to 2006. Taking this further, Janice Henderson also in their right-hand chart are tracking this phenomena, but I want to draw your attention to the chart on the left-hand side, where they've tracked the change in the price earnings multiples since December 2021. And the standout is real estate on the left-hand side, which is the multiples are still 30% below those seen in December 2021. This despite US REITs having grown earnings by 20% since 2022. We ourselves have been tracking this phenomena in a different way, in that we are tracking the S&P's total return relative to the global property index from the 1st of January 2025, when it looked as though global property was starting to make a comeback. However, this was short-lived, and the divergence is still in position. However, what I have done is taken out the performance of property since the 1st of November 25 up until last week, the end of January. And as you can see, global property has been holding its position relative to the S&P. and in no way saying that is an inflection point, but it is, I believe, that the market is starting to recognize this undervaluated and almost abandoned sector of the 11 sectors making up the S&P. So I mentioned that Nareit identified two divergences, and that the first one, which I've just covered, is the broader stock market and REITs. But they also have noted that the gap between REITs and private property is significant. If I can explain that a little bit further, private property, or what we know as directly owned property, or property not owned by REITs in the US, makes up approximately 85 to 90% of the capitalization, the balance being held by REITs. It is a large, liquid, and active market. And taking this further, one of our research houses, Green Street, actually construct their own commercial property index. It's a very reputable organization, and not only do they research the REIT market, but they also research the commercial property. And this index that they construct is a time series of unleveraged US commercial property values that captures the prices at which commercial real estate transactions are currently being concluded at. So what it effectively does is capture the changes in the aggregate value of commercial property. And here's this index. Going back to 1998, up until 2012, the index was below the mean and would provide great pickings for REITs that could buy commercial properties, obviously the better commercial properties, at valuations below their own earnings multiple. This turned in 2012, and as Nareit has pointed out, there's still a significant divergence between this index and its mean going back to 1998. Just on the quick look at the fundamentals that are underlying the REIT properties, and that is Janice Henderson here again has constructed this chart, which reflects the movement over the last 4 years, over the last 3 years, with the estimate to 2026. Now, one of the biggest threats to property values is oversupply. And what these charts are demonstrating is that in most cases, supply is declining as a result of the higher cost of capital and construction costs. Looking at the apartments, you can see that supply peaked in 2023, and there's been a steady, if not precipitous, decline, and very little is coming on relative to the past is coming onto the market in 2026. Whereas industrial, or the logistics REITs, peaked in 2023, and then there's been a continuous decline in supply. If I can skip then to the senior housing, there has been steady, slow but steady growth. This is on the back of what is known as the silver tsunami, as the aging population needs this type of accommodation. And even though this supply is increasing, there's in no ways a threat to the healthcare REITs. Similarly, self-storage is following the same pattern as that as apartments. And these few selections of the 30 sectors that now make up the REIT market, most of these charts represent a fair situation where there is not too much supply coming, or even lower supply coming to the market that would threaten rentals. So in the words of Nareit, it's difficult to time the end of a market dislocation, but historically, every REIT equity market valuation multiple divergence has had a convergence. While the duration of the current divergence remains unclear, it may set the stage for future relative outperformance in 26 and beyond. Now, this is quite a profound statement by very conservative organizations like NAREIT, who went on to say that one or both of the divergences could close in 2026. In the time being, there's been a rise in initial public offerings, and this is expected to continue into 2026. However, the mergers and acquisition activity has already started, in particular in the last quarter of 2025, and already a number of transactions have gone through this in January of this year. So we ourselves have been tracking the global property index since the January 2022, when we had the sharp rise in interest rates on the back of US inflation hitting 9.8%. It has moderated, but we saw a precipitous decline in 2022, a sideways movement, and it looked like a breakout in the middle of 2024. However, we were hit with by the 3 tariff tantrums. The third in particular was in April 2025, where we had a significant decline, but the recovery was very quick as the market recognized that the earnings were intact, and there's been a continuous improvement up until January of this year. More specifically, of late, the index has broken above these resistance and is a line of 1600 and is sitting above there. In no ways am I implying that it is a inflection point, but the market is identifying and starting to pay attention to the global property market as we see volumes are increasing. Just want to say is that this recovery is not reflected by South African holders who've come in with rands, as the significant improvement of rands has masked this performance at this point in time. I will address this phenomena later on in the presentation. Finally, it would be amiss of me not to make note of the data center REITs, of which we are still overweight in. Here is an image of a campus owned by Digital Realty. They own the property. They provide standby power and the cooling that is required to cool the vast amount of processors and data storage facilities owned by the tenants. And it is these tenants that have signed up long-term lease. In the main, it is not only just the Mag 7, but it's the mid-cap and the small-cap techs that are taking up space in these particular properties. They also, in the main, are priced to perfection, and just one slight underperformance of reporting has already we've seen a major change. Just last week, Microsoft declined 12% in the day. It has recovered somewhat. On the same day, though, Meta raised 8%. So there's a lot of volatility on these tenants. They've signed up a lot of leases. Should there be a major correction in the AI environment in particular, it could filter through the entire market, and it could also affect these data centers. However, should the market calm down and start seeing that these tenants are still paying the rentals, there may be a revaluation. So if you can put up the poll at this point in time, what I would like to do is focus on our REITway Global BCI Global Property Feeder Fund, where there has been some changes. We have changed our benchmark to a more diversified index, that being the REITway Global Property Diversified Index. which is calculated and maintained by Selective in Germany, even though it bears our name, and was constructed together with their subsidiary to Global Property Research in Amsterdam. And the prime objective was to develop an index that outperformed the generic and the existing global property indices, which it does. Now, a change of index invariably creates a degree of justifiable suspicion, and there's two types of suspicions, and the first one being is, are we changing the index to generate more income for us? This is definitely not the case, as we do not charge a performance fee for the management of the portfolio. And the second one is that it is used to show a better performance if it is an underperforming performing index. And this is definitely not the case, as this index over most periods of measurements outperforms the indices, the general indices that are out there. This was achieved by increasing the universe for which the index is extracted. And I'll give you an example. Our benchmark up until the end of December precluded about 25% of the market capitalization of REITs. And so with this broader universe, this enhances performances. And not only that, it has actually narrowed down to 60 holdings. It's more concentrated than the other global property indices, which range from 250 to 500 holdings. So this concentrated performance on top of a broader universe from what it is extracted is delivering a higher performance. And it helps us in our portfolio construction process to allocate, when it comes to allocating to the geographies or the countries, the sectors, and also the actual individual holdings. Our portfolio averages about 40 holdings, of which 7 of them are not actually in this index. So we are active managers, and our objective is to actually outperform our benchmark. Taking this further, we had the privilege of working with Selective, who have access to vast amounts of data. And not only that, we're working with professionals and efficient professionals who are able to extract the information that we needed in an efficient manner, and would go backwards and forwards, and they assisted us in the interpretation. And it actually became clear that for the REIT sector, in no ways am I implying it for the other sectors, but in the REIT sector, it is the quality and momentum factors that contribute the most to performance. It may be a surprise that value is the third contribution, and I don't want to downplay the importance of the value factor, but you must realize that REITs are part equity and part bond. And if I tell you that there's 30 REIT sectors, some are very equity-like, for instance, the data center REITs, and some are very close to bonds in their behavior, and that would be the net lease type properties, REITs. And expanding on that further, here is the list of the sub factors that make up quality. I won't run through them, but each is measurable in objective financial metrics, and that's metrics with an S. Some of them have got multiple factors, multiple metrics of measure of these particular factors. So, however, it is our view that the most value-adding elements of quality are often revealed only through a track record, particularly management's ability to consistently deliver accretive acquisitions, developments, and disposals albeit it comes with a degree of subjectivity. But it is these skills that ultimately differentiate outperforming REITs over time, and we are cognizant of this in our portfolio construction process. To conclude, I mentioned the Rand. The Rand is very strong, and a lot of to the existing shareholders, to the investors who held our fund over the last 4 years, I share your pain, as I have got a lot of personal exposure. Whereas at this point in time, it's an unusual situation where you can take our very strong Rand, which is way above the trend over the last 30 years relative to the dollar, and in no ways I'm suggesting that there's a convergence. It could actually still strengthen, but you should be using this opportunity to buy undervalued, underappreciated assets like global property, which reflect sound earnings growth, sound visible earnings growth that continue to outperform inflation. Thank you.
Greg, thank you very much for that. Just one very quick question. What is the correlation between global bonds and global property?
You have to break it down into the 30 different sectors, Eugene, to have a look at it. So global bonds and global equities, if you're looking at, for instance, the net lease. Now, net lease is simply the landlord owns the property, and the tenant looks after the maintenance, pays the rates and taxes, enhances it. So it's very bond-like in its behavior. Again, I go back to the example of data centers. There's very little or no correlation between the bond market. That is different to what, for instance, general equities are.
There is a question from the audience. I want to take it very quickly. Any info on the yield versus capital gain going forward?
So the yield is, if you go back, you can recall that slide where I said that showed that Janice Henderson showed that the price earnings are 30% below what they were in December 2021. There, the price earnings was about 2.25%. We're sitting in a range between 4 and 5% at this point in time. So again, there's huge room for when the convergence starts, when the reallocation and the rotation comes back into property, there's significant scope for growth in the values on that metric alone, on that being the average yield.
From a valuation perspective, I have to agree with you. There's a lot of room for improvement. If we look at the polls that you have had up, about 11% of the audience said strong recovery, but let's see, time will tell. About 20% of the audience said sideways, and about majority, 67%, 68% said gradual improvement. Let's see, time will tell, and we'll keep an eye on global property. Greg, thank you very much for your time today. Grateful.
My pleasure. Thank you.
Right, we are moving on, and some of you were introduced to Guinness Global Investors during our 2025 roadshows. We got to meet Flurry Wright and Dr. Ian Mortimer. Today, it's my pleasure to welcome Matthew Page, all the way from London, portfolio manager at Guinness Global Investors. Good morning, Matthew. How are you?
Good morning. Very well. How are you doing?
Good stuff. We're really good. Thank you. And thank you so much for joining us this morning and your time. You focus on quality dividend-paying companies. And like I mentioned, we got to see some of the workings of your fund, but always interesting to see why you believe these companies will outperform. Thank you. We're ready for you.
Okay, let me share my screen. Super. Okay. Well, if we jump in there. So just a quick reminder on the strategy. So this is a strategy we've been running since 2010. We have about 6 billion British pounds in the strategy, and it's a concentrated portfolio of 35 stocks. So we invest in high quality companies that we think are going to be able to compound and grow their dividends over time. But I thought it might be worth just starting by having a quick look back and kind of from a macro point of view of, what happened in 2025. And I think, the big thing that stood out to us from a global equities point of view was just this outperformance of non-US equities for the first time in any meaningful manner for really the sort of last 15 years or so. So these green bars here represent periods where non-US equities are outperforming, and the blue bars are where the US is outperforming. An interesting factor as well was this quality factor actually had probably the worst year for the last 30 years. And what this chart is showing you is the performance of the MSCI quality index less the MSCI world index. So just trying to isolate that quality factor. And we're showing each of the last 30 years in aggregate over this chart. So you can see the red line is 2025. And then you can see this grey line represents the bottom decile. So over the last 30 years, on average, quality companies globally have outperformed the MSCI World by about 2.8%. So I think it's definitely a place you want to be over the long term. But to put 2025 in perspective, it was not a good year for quality. If we drill into that a little more detail, what we're looking at here is MSCI World Growth versus value. And we've broken this down in red into the US and in green into Europe. And so when the chart is going above this zero line, that is growth outperforming. And when it's going below this line, it is value outperforming. And so you can see over the first few months of last year, you had US value and European value outperforming, i.e. these lines were both going together down. And then around April, we saw US growth starting to outperform, whereas it was European value that continued to outperform. Whereas if you look at world growth and versus value over the whole year, they actually performed about the same. So as we also know, it was US tech driving outperformance in North America, and it was more like European banks and defense names outperforming in Europe. It's also interesting when we look at what was driving total returns in those two regions. So on the left, you've got the US, and we've broken down the price return in black into two components, the earnings and the valuation. And so you can see in the US, the valuation, this blue line, has essentially gone sideways over the year, whereas the red line, the earnings, is what's driven the performance of the US market. And that's in contrast to Europe, where you can see on the right-hand side, the complete opposite. In Europe, earnings essentially went sideways, and what drove the performance of European equities was valuation expansion. So equities got more expensive in Europe and earnings went sideways, whereas in the US, earnings went up, but the valuation went sideways. What have we done over the last year? Well, we sold two healthcare positions last year. We sold an Australian pathology business called Sonic Healthcare, and also Novo Nordisk after their results in July that we found very disappointing. And we replaced them with Haleon, a UK-listed consumer health company, and Anta Sports, which is a Hong Kong-listed Chinese sportswear brand. In terms of what happened to dividends in our portfolio last year, it was actually very strong. We have 35 names in the portfolio, and 34 of them grew their dividend, whereas one kept it flat. But we didn't have any dividend cuts or cancellations. And on average, you can see they grew their dividend at around 6.8%. So a pretty healthy dividend growth last year. So how are we positioned as of the end of the year? Well, you can see our portfolio breakdown here. So there's all 35 names. And you can see at the moment, our portfolio trades at about a 5% PE discount for 2026. And if we look at those positions in terms of how we are positioned relative to the index, you can see our biggest overweight is in consumer staples. And certainly year to date, that's been very helpful. As we've seen this little wobble in the market, we've seen kind of pretty volatile markets already this year, and having those sort of defensive properties of staples has been helpful. That's somewhat offset by our overweight to the industrial sector. And then we are underweight financials, tech, comm services, consumer discretionary. And then we have zero weights, as you can see, in real estate, utilities, energy, and materials. And from a geographic point of view, we are underweight North America and overweight Europe, essentially. What that means in terms of the statistics on the portfolio is we have a portfolio that is earning double the return on capital of the index. As we saw earlier, it trades despite this much higher quality characteristics at a valuation discount to the index. We're currently offering a dividend yield of 2%, which is modest, but well above that of the index. And as always, we have 35 names, which gives us a high active share. So in terms of where we go from here, I mean, I think our conclusion is that we think this is a fairly favorable backdrop in terms of fundamentals, at least, for equities this year. And I think there's a number of reasons for that. Number one, central banks are continuing to ease policy rates, certainly in the US, expected to continue this easing into this year. We're going to see something similar in the UK. Perhaps the European Union is now going to be going sideways in terms of interest rates, but certainly all eyes are going to be on the Fed, and that I think is a positive backdrop for equities. Secondly, I think you've got quite significant fiscal stimulus coming through. Clearly in the US, the one big beautiful bill, as it's so called, is a large stimulus of around $3 trillion, and we're just comparing that to previous fiscal stimuli in the US. It's not just in the US where we're seeing this fiscal stimulus. Obviously, in Europe as well, we are seeing a big ramp up in defense spending as well, which will have a similar impact. Again, if we look at what's going on in terms of capex in the US, obviously the hyperscaler capex is really significant and growing very rapidly, and upgrading, it seems, each quarter in terms of what capex plans are. So, this year we're expecting currently $533 billion to be spent by the 5 hyperscalers, and that is expected to grow to $600 billion next year. So again, this is a sort of positive stimulus for economic growth. And if you then factor in the US deregulation as well, that is certainly a positive impetus. So easing monetary policy, fiscal stimulus, increasing capex, deregulation, what does that mean for earnings? Well, you can see here for the MSCI World, the dark blue here is 2025 and the light blue here is 2026. So we're expecting earnings growth to actually accelerate in 2026. And that is true across most regions. So if we look at the Euro stocks, actually, we saw negative growth in earnings for the stocks in 2025, and that's expected to turn significantly positive. We're seeing the same in the US. We're seeing the same in EM. The only place where you're seeing potentially a slowdown in earnings is in the Magnificent Seven, but still very, very strong earnings growth, of course. What do valuations tell us? I mean, this is where we should probably pause for thought. Valuations currently in pretty much every region look expensive relative to certainly their 5-10 year, but 20-year history as well. Maybe the exceptions to that, I would say, would be Japan, China, and UK, but certainly, European equities, I would argue, are not looking particularly cheap relative to their history now. What are the risks to this sort of more positive outlook for equities? Well, clearly within the hyperscalers in AI, there is huge amounts of money being spent. We're concerned around the sort of circular nature of some of that funding, and also the amount of debt that is being raised to drive the investments, particularly for the likes of Oracle, which we do not own. If you look at the capex, the cash flow from operations, so how much they're spending to build out these data centers versus how much cash they are generating, that they are now spending more than they are earning. Therefore, they are raising debt, and okay, they're managing to do that, and the market was actually oversubscribed for that debt issuance recently. But that is something to watch. I think we need to keep a close eye on the US labor market. Data there recently has been positive, but I think if we were to see a pickup in unemployment in North America, that has quite big implications for economic growth. And of course, I think we need to keep a continued eye on inflation. So far, the data looks okay, but if we were to see that tick up, I think we need to be ready and alert. So all in all, I think 2025 was a positive environment for equities, particularly outside the US. But outside the US, that return was certainly driven by valuations getting more expensive rather than earnings growth. We're seeing this big capex stimulus from AI, but there are questions certainly over the longevity and ability for companies to continue to fund that growth. As we saw earlier, this combination of monetary stimulus, fiscal stimulus, deregulation is all leading to a positive outlook for earnings growth, all else equal, and therefore that should be a good environment, we think, in 2026 for dividend growth as well. We've got to be aware of valuations. They are looking relatively expensive, but valuations don't tell you much in the short term, of course, about the direction of markets, but they do give you a sense, I think, of what the returns could be over the longer term. As I showed you, that quality factor was actually the worst year for quality since 2003. But what that means today, I think, and as we're seeing at the moment in this volatile market that we've seen year to date, is that quality valuations are looking quite attractive now, and certainly for the certainty and outlook of their earnings and dividends, we think they're an attractive place to be. So thank you very much.
Thank you very much for that. One very interesting slide you had up was the big improvement in earnings growth that you expect for 2026 of Europe. Does that have anything to do with your big underweight to US and relative big overweight to Europe?
Yeah, I mean, largely our process is a sort of bottom-up approach. So it's really a reflection of that. And I think when you're running a global dividend strategy, you tend to find better dividend yields available in Europe than you do North America, because a lot of the capital that is returned to shareholders in the US tends to go through a share buyback. But I think we are certainly seeing an improving outlook for European companies more broadly. Typically, European indices are dominated by European banks, and we don't own any European banks. We never have done. We've never invested in banks because their returns on capital are too linked to the capital cycle for our like, and too exposed to regulation. But certainly, I think beyond that, Europe still has some great industrial companies which we think are really attractive alongside some consumer staples.
Your fund name, very interesting indeed, the Guinness Global Equity Income Fund. It's because you focus on companies with high dividends. But typically, I mean, and you've got historic data as well, does high dividend paying companies outperform over time?
Yeah, well, we're cautious about just going for the sort of highest dividend yielding companies. We think what you want is companies that have got the prerequisite to pay sustainable dividends over time. And when you drill into the dividend factor has been a source of outperformance over a long period of time. But what you want to avoid, and what drives the performance of that, is you want to avoid companies that cut their dividend. And you want to identify companies that grow their dividend. The outperformance of the dividend factor comes from dividend growth. So our whole process is set up to try and avoid dividend cutters. And often the companies that are most likely to cut their dividend are companies that have relatively high dividend yields, because the market is saying effectively, we don't think those yields are sustainable. They tend to have weak balance sheets, which means that any free cash flow needs to go to sort of shoring up that balance sheet. They tend to trade on quite low valuation, so they can often look like kind of great value opportunities, but are actually value traps. So I think that for us, over a business cycle, you need to be focused on companies that can pay that sustainable dividend and grow it sustainably, and not cut it when you get to the inevitable recessionary period.
That's a quick question from the audience. What are your holding period on average of some of these companies?
Yeah, so typically we'll hold companies for 3 to 5 years. There's a handful of names that we have owned the entire 15 years we've been running the strategy, but typically 3 to 5 years.
Definitely a strategy that's proved to work over time. Matthew, so thank you so much for joining our session this morning. all the way for London, and good luck with the rest of your week. Thank you so much.
Thanks very much.
Moving on to global emerging markets, and joining us from Riskera is Lars Hachenbach. Good morning, Lars. How are you doing?
I'm good, yes. Thanks, Eugene. Lovely to see you guys again. Perfect.
Lars, emerging markets, very interesting indeed. And I mean, it showed in the past that it can add some additional volatility to portfolios. But I mean, if you look at valuations currently, it's something you just can't ignore. The question, I think, for a lot of investors is how much to allocate to emerging markets. And of course, there's a lot of tailwinds from a weaker dollar. Interested to see how you see these markets and what you do in your funds. You've got two funds. You've got the Riskera BCI Emerging Markets Equity Feeder Fund, but you also have a China-specific fund, and we'll see if there's questions coming on China-specific. Thank you for your time.
Okay, thanks, Eugene. So yeah, the previous presenter, Matthew, obviously did a very good job of highlighting some of the opportunities and recent performance, in fact, in emerging markets. It was a very good year, 2025. Emerging markets up around about 30%, driven primarily by the Chinese market, which is about 1/3 of the total. What I thought I wanted to do this morning is to share some of the insights and learnings from a research trip that we did to the Chinese mainland last November, with a particular focus on trying to understand what's going on in the Chinese consumer landscape, which is one of the key drivers, as we can see, of performance in that region. I think I appreciate some of you may have seen this material before. We did a presentation shortly afterwards, but I thought it was really compelling stuff, and I wanted to share that with a much wider audience. So I'm going to give a little bit of a highlights presentation to you all today. So what I wanted to do is to really just explore some of the behind-the-scenes consumer business models that we found in the Chinese market, particularly in the Chinese mainland market. And then to your point, Eugene, just to talk through how one accesses that opportunity. Is there still an opportunity? What are the current tailwinds that might make an allocation to emerging markets worthwhile over the next sort of 12 to 18 months? Those of you who know us, we obviously are emerging market specialists with folks in the region and a considerable amount of money allocated there. Okay, so behind the scenes into the Chinese consumer type of consumer brands and their business models. There are probably about 4 or 5 different business models that I wanted to quickly highlight today. And these are really ways in which Chinese brands have dealt with or have approached either existing incumbents in their market or how they are looking at expanding beyond the purely domestic marketplace. The first one is the idea of a local brand displacing a global incumbent. So Starbucks logo on the left, it's a well-known global coffee chain. They have about 8,000 stores in China. They look a lot like the stores you have in Western countries, in the UK, in the US. But a local player by the name of Luckin Coffee has basically come along and has displaced Starbucks. They now have up to 30,000 stores. They're a homegrown domestic brand. How have they done this? Why have they done this? Well, they've basically come up with a retail concept that is more tailored, more specifically aiming at a Chinese consumer. They use little kiosks. They have the idea that in a Starbucks, you often have people who sit in a Starbucks on a Wi-Fi all day long. Luckin Coffee doesn't even do that. They don't even have places to sit down. It's more of a buy your coffee and go. Everybody in China, I mean, people are quite hardworking. They don't have time to sit around and chat. So they go in, they buy their coffee, and they're off. And so a retail concept, a shop front that speaks to that type of behavior is likely to be more successful. And as we see that, Starbucks has basically been supplanted by Luckin Coffee. In fact, actually, Starbucks sold their Chinese operations to a Chinese venture capital operation last year as in an attempt to try and revive the fortunes of that business a bit more. The next type of business model is a Chinese homegrown brand that then goes global. PopMart, this is possibly a company that you guys have heard before. Certainly they've made inroads in many of the developed market countries. They sell little dolls, they sell fashion jewelry, they sell trinkets. If you, oops, let's see how this is going to work. There we go. There's a typical Pop Mart store in Shanghai. They have Pop Mart vending machines. Right here is a vending machine in a Chinese rest stop. It's like a Caltex one stop by the side of the highway, and there you can buy various Pop Mart things out of a vending machine. But this is all domestic China. They also have Pop Mart vending machines in London. Here's one in Greenwich, in the O2 Centre. It's the big exhibition centre in London. There's a Pop Mart vending machine there. And believe it or not, they even have one in Paris, a giant Pop Mart store in Paris, La Défense. Paris, of course, known as the fashion capital of the world. And here we have a Pop Mart store in La Défense. So we have a Chinese brand that has gone from making Chinese products aimed at the Chinese market, and through clever marketing, through viral advertising, through social media, they have basically been able to expand that so that they now have a very huge global following. Local brands making inroads into Western-dominated retail. The high-end retail sector is dominated worldwide by Western brands, by French brands, by Italian brands. This is a picture of the IFC Mall in Shanghai. It's a high-end shopping mall. It's one of many, I'm going to say hundreds of shopping malls across China. The Chinese have a reputation for being extremely brand sensitive when they buy products. So here we have, this is a 4-5-story mall. There's some more basement ones that are not in the photograph. And it's wall-to-wall Western brands. As you can see Dior, I can see Furla, I can see Balenciaga in there. And in amongst it all, if you spend some time walking around, then you'll find a Chinese brand called Laopu Gold, which is now the first, at least to our knowledge, the first homegrown Chinese brand that has been considered worthy, if you like, of having a storefront inside the IFC Mall, right? And in fact, there was a queue of people trying to get into the Laopu Gold. There was no queue of people trying to get into Dior. So this is an example of a domestic Chinese company, domestic Chinese brand in the high-end retail sector, whose products have been basically designed and developed with Chinese tastes in mind, the type of items they sell, maybe the type of designs they use, the kind of materials they use are very much aimed at a Chinese consumer. And it's been extremely popular. And, we then say, what's kind of the gross merchandise value of these jewelry brands? This is in a slightly different mall in Beijing, a slightly bigger mall. And Laopu Gold, their gross merchandise value over the course of 2024 almost more than doubled, whereas everybody else's went down. So the Chinese brand is actually taking market share away from your existing high-end, well-recognized global brands, the Cartiers, Bulgaris, Tiffany's of this world. So the idea here being that basically the local consumer companies are challenging your global incumbents, that they're responding to the changing habits of this world's largest consumer market. The barriers to entry for newcomers, reasonably low, and you have an army of hungry, talented entrepreneurs in the Chinese market, eager to exploit the billion-ish consumers that they have on their doorstep, many of whom are getting much wealthier due to urbanization, due to basically moving more and more from a primary economy, so from agriculture and basic manufacturing into high-end manufacturing and services. The next business model is actually, ironically, Matthew also spoke about Anta as one of the companies in their portfolio, but this is an example of a very successful, in this case, sportswear company, a Chinese company, which has grown through acquisition. So they had a very successful domestic brand, making trainers, or tackies, sports gear, sports clothing, and through acquisition, they've gone out globally, and they now own a whole range of well-known Western brands: Fila, Wilson tennis rackets, Atomic ski gear, Salomon ski gear, Arc'teryx, Jack Wolfskin. So they have basically used the profits from their Chinese operations to expand globally. And actually some quite interesting retail models have come out of that. Arc'teryx in particular, it's a very high-end sportswear company. They make jackets, they make winter gear. The store in Shanghai that we went to go and see had almost no stock in it. The entire sales model is one of buy by invitation. So they have salespeople, they'll email a whole bunch of clients. The clients say, yeah, I want this jacket, or I want these pair of boots, or whatever it is. And then they use the store as an experience place where you go and you collect your merchandise, and you can go and test it by climbing up a climbing wall in the back of the shop. You can go and have coffee in the corner. You can talk to the people, the salespeople. You can learn a bit more about the product. Make sure you stay on the list so when the next thing comes out, you get invited. It's a very different business model. And that one store in Shanghai alone turned over something ridiculous like $50 million a year. It's just phenomenal the amount of money that you can make from the Chinese consumer. If you get a great business model, you get a good product, you speak to them in a way that that resonates with how the Chinese consumers are thinking. Okay, the final one that I wanted to have a quick look through is Xiaomi. So, or Mi as the kind of branding goes. I think this is a company that some of you are familiar with. They make cell phones, but that is kind of what people think of Xiaomi as. They're a cell phone company first and foremost, but actually they're one of the very few companies, if not the only company that I'm aware of, that we're aware of, that have a complete multi-product ecosystem, right? So they make phones, they make TV screens, they make wearable glasses, they make fridges, they make coffee machines, they make water purifiers, they make light bulbs, they make robotic vacuum cleaners, they make power tools, they make charging devices, they make watches, they make electric scooters, and of course they make cars. Right now, you find me a company anywhere else in the world that has such an extensive brand range, product range, as Xiaomi. Apple, they make a lot of technology things. They do have a reasonable range. Unilever, let's say on consumer goods, they make a lot of fast-moving consumer goods. The Easy Group is a sort of slightly left field example. They do travel, hotels, ships, and so on. But I'm not aware of any company in the world that has quite the brand range, the product range, as Xiaomi does. And this is just a uniquely Chinese phenomenon. And they're able to do that because on the one hand, you have a very, very large domestic market. And the other hand, which is perhaps the more compelling one, is the ability to manufacture these products quickly, reliably, and close to home is second to none. China is the only country in the world where you're able to have a supply chain, full end-to-end supply chain. Right? You can get, this is slightly different example, but I know we went to go and visit a robotics factory, guys that they make humanoid robots. And they were saying to us, well, if you had a blueprint for a robot, somewhere in Shenzhen, in the space of a week, maybe 10 days, you can get a company that will make a prototype for you from scratch. They'll manufacture all the panels, they'll make the motors, they'll make the controller units. You can have all of that done in 10 days. Find another country in the world where it's possible to do that. It's just absolutely phenomenal. The tapping into the supply chain that is available in those larger Chinese cities. Like I say, with it, the market on your doorstep, manufacturing on your doorstep is absolutely incredible. Anyway, so enough of the opportunity. Is there kind of, actually we can skip that one quickly, accessing the opportunity. So as I think Matthew also made a slight mention of that, if you compare like-for-like companies in the US or the Western world with the Chinese equivalents, then it quickly becomes clear that the entry points for the Chinese companies are at a much, much cheaper point. Now, this is a technology comparison over here. So there's a bunch of the kind of Magnificent Seven on the right-hand side, plus a handful of other tech companies, and looking at similar companies on the Chinese side. Right, and your weighted PE for the American companies on a forward-looking 2026 basis, around about 35, a little bit less if you exclude Tesla, which has this stupidly high valuation. But in the Chinese one, you're looking more like 18. So you're getting the companies at approximately half price. Now, yes, there are some greater risks. It is an emerging market country. There are maybe some geopolitical issues to deal with, liquidity issues possibly, depending where you're coming from. But half price? No, come on, that just doesn't make any sense. Right? And so if you look at the relative performance, this is, on the left-hand side is the historical numbers through 2025. I mentioned that emerging markets had a great year, 2025 already. And, if we look at the numbers on the right-hand side, forward price earnings, it's very clear that the Chinese markets, and with that, the broader emerging markets, have quite a bit of opportunity left to go still. Right? And somebody also mentioned, I think it might have been you, Eugene, the impact of the dollar. So emerging market performance relative to developed market performance, as you can see from this chart, is very, very strongly correlated to the dollar, specifically to a weakening dollar. So it's negatively correlated. So typically when the dollar weakens, then that's great for emerging markets for a number of reasons. The most important probably is that the willingness of developed market investors to hold capital, to hold investments in their home currency and earn dollar interest rates becomes less attractive when the dollar weakens. And in fact, then the capital starts to flow out into emerging markets, which then drives economic growth, which drives stock market performance. And also, as we've heard this morning already, the trajectory of interest rates in the US is likely to be lower. So we've got a political pressure for that to happen. And that all speaks in favor of a weaker dollar, which then portends quite well for another successful year in emerging markets. So yeah, Chinese, the same story really. The correlation is very negative between the dollar there. And then just looking at forward expected growth for a select number of markets, this is also quite similar to the picture that Matthew put up just now. Certainly there are a number of emerging market countries on here. Looking at the far right hand side, for example, the Nifty 50 is India, Asia ex Japan, as very, very high expected growth, EPS growth forecasts for the year 2025. Okay, I know this is a short session. It's just a highlights package. For those who are thinking of allocating to emerging markets or exploiting the opportunities, we would just leave you with a couple of thoughts that it's really important to have on-the-ground expertise to be successful in emerging markets. It's often difficult for foreign researchers to properly understand, particularly those who are based in one of the large developed markets, in financial centers like here in London, like in New York. You often miss out on some of the nuances of actually being in the region. Local dynamics are very fast moving. It's important to identify trends early. It's important to understand how the government's policy or other local governments, provincial governments, how they are interpreting guidance and what it means for domestic and local opportunities. So it's really important to have those folks on the ground who understand those trends. And then just to find final words to leave you with. So if you're looking at the Chinese opportunity particularly, we've looked at a couple of business models where Chinese companies are very successfully displacing their global incumbents. The tailwinds from a weakening dollar, so the currency tailwind, as well as the incredible amount of development on the technology side, the robotics side, the AI side, are very, very useful tailwinds. And you're getting everything in at an attractive valuation. So we would certainly argue that the potential benefits of having an emerging market allocation, even a modest one, for the next 12 to 18 months really are quite compelling. And then, thank you. Any questions?
Oh, it's very insightful indeed. And I mean, emerging markets in China is extremely topical at the moment. And I know a lot of investors are considering that 2025 was indeed a good year for both your funds, emerging market and China fund. I just want to check your views quickly on China versus India. You showed good, strong expected earnings growth in India as well. In an EM fund specifically, not your China fund, would you look at India? Because I mean, India had a dismal year last year. China did well. What would your allocations be to India going forward in 2026?
Yeah, so India is it vies with Taiwan for the second most important constituent of the emerging markets index. India is very attractive in terms of it's the world's largest population. It obviously has gone through some more business-friendly political changes under the Modi administration. Now, you're right, 2025 was not a great year for India, but it had a very strong run up to that. So you could argue it's more a case of some profit-taking happening there and some slightly more realistic valuations for India. But we are still constructive on India. It's a little bit like China. It seems to be having some geopolitical issues that it's dealing with, particularly with the US. So India's relationship with Russia is coming in the spotlight. They're buying most of their oil from Russia. Obviously, they get a good price. And that's not sitting very well with the Trump administration. So there's in the last months, there's been some anxiety there about what that means for tariffs in India. I know very recently they actually, the Americans walked back their tariff threat. So there is, that is an overhang in India to bear in mind. But certainly the long-term prospects I think for India are quite strong. You may have remember one of the charts I put up just now, certainly for 2025, India ranks among the top 3 or 4 in terms of regions where 2026 earnings growth is likely to be the strongest. So we would maintain a benchmark weight at very least for India.
Lars, another conundrum that SA investors are often faced with is saying, SA investors have a large chunk of their assets invested in SA, which is an emerging market. Why should I include another emerging market fund? You showed some very, very interesting companies, for example, of interesting companies in places like China, which you won't find in SA. I mean, the SA story has been driven predominantly by resources the past year and a half, and we all understand why. But just on that, how should SA investors think about your emerging market fund in a portfolio?
Yeah, no, actually, very, very valid question. And the good news, I guess, is that we actually, I thought I could find the chart very quickly for you now, Eugene, but it's hidden somewhere. But we actually did an analysis just recently to look at the correlation between South African equities and emerging market equities more broadly. And the correlation actually is quite variable. So it's not that the number is not very stable. And it ends up being, sort of somewhere in the 0.6, 0.75 range. Whereas, a number of 1.0 would be very strongly correlated, -1 is negatively correlated. So it is correlated, but actually offers some quite surprising diversification benefits, notwithstanding what you said, that South Africa is, of course, itself an emerging market, does have a resource angle. And the reason for that is really that many of these emerging markets, like China, like Taiwan, like South Korea, they have industries and consumer trends and domestic technology that simply doesn't exist in South Africa. Right? There will be some other markets like Brazil, for example, which are very similar to SA. They also are resource driven. They have a similar type of population makeup or GDP per capita. Those sort of things might be similar. So there's going to be some overlap. But a country like China or Taiwan, has very, very little to overlap with the South African market. And so it actually does provide some very, very useful diversification benefits, even if you're coming from an emerging market standpoint.
And especially if you look at the expected earnings growth and obviously tailwinds from a weaker dollar.
Indeed,
I'll get one. Yeah, exactly. I'll get one of the other presenters to comment a bit more.
Sorry, just to
the views on dollar.
It's even sort of slightly counter-cyclical, right? If you think that if resources don't do well, it becomes cheaper to make things in the Chinese market, not good for SA, great for China. So it's sort of counter-cyclical even at a macro level. So yeah.
That's a very valid point, and maybe you can share that slide if you can find it with Olga, and we'll try to include it with what we post on the Boutique Manager's website as well, so that our audience can access it there. Yeah, Lars, thank you so much for your time. It's always insightful and great year for you, and let's see what happens. Yeah, thank you.
Thanks, everybody.
We're going to continue conversations on global equity, and at the ready, it's my pleasure to welcome Faniel Tigeri from Ballon looking at advantages of portable alpha in global equity. Faniel, thank you very much for joining us this morning and your time.
Thank you, Eugene, and morning to the rest of the listeners and investors there. So I've got a few slides on global equities and 1 or 2 charts on global bonds. Then just share some of the efficient ways to be able to exploit the value that we see in the market. I'm just putting my slides. I'll just have just a slide to show who we are and where we are in our journey. So we a largely quantitative investment house. Sorry for that. And we follow a bottom-up approach where we look at the macroeconomics just to determine large AA exposures to sectors and your asset classes. Then we use the bottom-up approaches, fundamental analysis, behavioral, and technicals be able to determine the actual securities within our strategies. And in terms of our size, we just over 20 billion rands, and we focus on four broad asset classes or strategies, which is multi-asset, equities, fixed income, and cash. So, and we also, in terms of responsible investment, to support that and giving back to our economies, to our communities that we work in. So today, I'll touch on in terms of the broad asset performance over the past year or the past decade, and touch we have one or two slides on bonds to be able to just show how asset classes have performed, and secondly, how the macroeconomy is sort of affecting the returns that we're seeing. So you'll find that I didn't pick a lot. I just picked our local assets compared to some select global assets, and you'll see that in rands, the local assets did quite well, both the all share and both the all share and the all bond index, like you're seeing. Then within the broad offshore markets, you see emerging markets. I think with the discussion that we had with the earlier presenter, also performed well over the past 3 years. So one thing to note is you see how the headlines have been in South Africa for the past decade, and you also see how the local assets, if you look at the offshore index, how it's performed last year and over the past decade, how last year affected the past decades. So we are a firm believer of using macro and obviously the fundamentals like what we've seen, but to just show that at times the news that or the headlines that we hear doesn't necessarily correlate to bad performance in the economy. So like we see with the all share and the bond index, but then globally as well, you will see that your global equities with the all country world index has done well, but emerging markets are starting to come in terms of relative performance. What we've seen in runs over the years is that you see that our global bonds haven't done well, because they would have done well in dollars, but because of the strengthening of the rand, the performance in global bonds wouldn't have come through for local investors. But like we've seen in 2022 or the earlier part, Q1 last year in 2025, global bonds work as a good buffer when there's volatility in the market. So what are the drivers of performances? I think that's what I'll look at, the macros. I mean, top of the story for South Africa-based investors was the precious metals and the rich valuations that we are seeing in EM versus DM. And what again I'll cover at the end of the presentation is just to find an efficient way of allocating capital to global equities and global bonds. So just as a driver, like I said, you see that all the asset classes have done well, equities, local and offshore, but then some of the performance that came through is not necessarily around the South African issue, but it's just the tailwinds that we're seeing in the global markets. So you'll find that in my chart, starting from the left, in the US, growth was expected to be about 2% in 2025. But, Liberation Day came early February, tariffs were announced that had a negative impact on growth. Then with all the immigration issues, largely in the US, that was negative again for global growth, and just the uncertainty with the change of administration in the US, and with the new Trump policies coming through, that a negative impact. But what also turned out over the past year was just the central banks, silently, the financial conditions were relaxed. In the EMs, cuts were coming through, and in the developed markets, it was just the quantitative tightening ending, and in fact, central banks largely were expanding, we started to expand their balance sheets. So that was a big supporter. Obviously, the headlines didn't come through as much, but and the dollar as well, the dollar weakening, it just loosened the financial conditions in the global markets. So that had a positive impact on growth and fiscal as well, expansion in the US and in Europe. We've heard from the earlier speakers speaking about the tax cuts that and the defense spending that's coming in Europe, and obviously to some extent deregulation, especially the offshore financials. So net drivers of earnings in equity markets was coming from these factors, financial and the fiscal bit. I'll just look at two charts as well, just to try to define the nature of the fiscal expansion that we're seeing in the global markets. I've got the US on the left-hand side, where we've got the fiscal balance, which is in blue. The more negative it is, it means that the US is using its fiscus to stimulate the economy, and it's showing that they continue to run fiscal balances, minus beyond 5%, and like we heard again, with there's growth that's coming in the US, and even the forecast in the coming quarters. Growth is expected in the US above the 2% real growth threshold that they've been running for some time. But even though there's fiscal expansion that's coming, you see that unemployment is rising, not drastically, not a recession rising of unemployment, but then unemployment is coming. So that fiscal expansion, coupled with unemployment that's slowly creeping, is supporting the equity markets in the sense that the fiscal expansion is not coming with inflation or with rising labor cost. And you'll see that that's the same kind of expansion that we are seeing in Germany on the right-hand side. The blue line, that's the fiscal expansion, apologies. Before COVID, Germany were running surpluses, in fact, but after COVID, the expansion came through, and come 2022, spending also increased in terms of support of the economy, and in terms of unemployment, it's also increasing, with the orange line showing that if it's going down, it means unemployment is increasing with a widening debt. So as the governments were supporting the economies, it's not coming with the tightening labor market. So two things that the recovery mainly is just benefiting the big corporates spending on AI, like we've seen from the earlier presenters. But then the consumer, with unemployment numbers worsening, the consumer is not truly benefiting, especially in the developed market. So with fiscal expansion helping our global equities, you wouldn't want to have a negative view regarding allocating money to that asset class. So one thing, obviously, that comes knowing that if governments are expanding their using the fiscus to stimulate economies is the threat of inflation coming through. On the left-hand side, it's just to show how you've got two lines, the red line and the blue line. Just shows that expected growth in the US is expected to quarter on quarter to be positive, around 4% quarter and quarter annualized. And on the right-hand side, it's showing that even though there's real GDP, we've got the blue line, which is a difference between labor productivity and real GDP growth. All we are trying to see is the growth in GDP. Is it coming? Where is it coming from? Is it productivity, or is it just fiscal expansion on its own? But we see that the fiscal expansion is coming with the improvement in productivity. We've seen how much the big corporates are pouring in AI infrastructure, and that's coming with productivity. And the reason why we focus on productivity is that when growth comes with productivity, it means that it's not coming with inflation. The other understanding is that when growth is quite strong, that might lead to demand push inflation. But in our case, it's coming through because of improvements in productivity. So we don't think the growth will come with inflation, and that's supportive of all assets, really, especially the risk assets or the EM assets. So the other bit that obviously just a byproduct of the geopolitical issues, especially after 2022, with I mean, without sounding, just to repeat, something that also affected the South African investor in the past year is how China has the China holdings of gold versus their treasuries. The reason I'm mentioning this is just the impact it has on gold, the impact it also has on the US dollar, because then it helps in the asset allocation. So we've got our chart on the left hand side, which shows China's holdings on the left hand side in US dollars. At some point, China held that's between 2010 and 2015. China held more than $1 trillion of US treasuries, but you've seen that those holdings have fallen to about 700 billion of US treasuries. So this is something that happened with their trade surplus expanding. So it's a reduction of about 30% over the past decade, and it seems that money was going to gold reserves, like you see with the white line there, showing that they've been increasing their gold reserves as they were going or lowering their treasury exposure. So with that, you find on the right-hand side, just to show again, I think the chart is a bit blurred, just to show the blue line, that's the gold price. You see there, and then the green line is just the reserve holdings from China over the years. So it seems as if gold has been benefiting from the diversification of reserves or surpluses, and this trend continued into year end. Obviously, we know the later part of last week of January, last month, there were wobbles there. But in terms of a macro trend, the falling dollar or gold prices improving had a positive impact globally, especially on emerging markets and especially to the South African investors. So local assets did well, but purely I think it was just in the context of the global macroeconomic backdrop. And just to mention one of the or a few key risks that we see, we did say there are tailwinds regarding the fiscus. There are tailwinds regarding the geopolitical changes affecting the EM currencies, the gold and the dollar. We just have a ratio, part of the technical tools that we did say inform our investment decision making, and the gold versus oil ratio to see how it has changed over the past decade. If that ratio is high, it just increases the likelihood of volatility. Usually when it's peaked, there's volatility in the market. So you also want to have your asset allocation appreciating that the fact that volatility might come through. So you'll see that that ratio over the past decade peaked late 2020, and it's around about the same levels as at the end of January. So that's one thing that you also want to have from a macro backdrop in terms of your portfolio positioning. Then the second chart on the right The blue line shows the realized inflation. That's the US headline inflation. Then your orange dotted line is what the market was forecasting inflation to be. So you find that end of 2020, mid 2020, inflation was expected to be about 2%. But it turned out, after the Feb 2022 Russia invasion of Ukraine, that inflation turned out to be higher. But the main point I wanted to, just to highlight here is that the market is quite poor in forecasting inflation. You see all the orange lines, the focus either is at 2% if the market is below 2%. And if inflation is above 2%, you see that the market always forecasts the inflation to be lower in the coming year, but at times it tends to be higher. So this comes with I think when I initially mentioned about the fiscal expansion coming without inflation, just to say the risks are if inflation is to go up, the market struggles to focus that bit. So I'll just have two slides just for the global bonds to see what also happened just from a macro perspective. You see that the EM story used rally. South Africa bonds, South African bonds did well, used rally. But just on a global scale, to say that you find that yields rallied on the short end in the global markets, save for Japan. But then one thing that we also note that is long end yields. So over the past year, you've got your 2-year yields, your 5-year yields, bonds maturing in 10 years and bonds maturing in 30 years. The rally that we see in global bonds is only affecting the shorter dated, the 2 years and 5 years. But in the US and UK, it affects all the terms. But in Germany and in Japan, you find that that rally is not coming, especially in Japan. If anything, there's been a sell-off there. So that's the other risk in terms of the fiscal expansion. I'll show in the chart in the charts below that the fiscal expansion in the global markets comes with the risks, and some markets, especially the guys in Japan or Europe, where there's issues with growth in terms of economic growth, that the bond markets are being a bit nervous there. Then just checking on the right hand side, seeing how certain sectors, you've got the US aggregate bond index that has done 6.8, but you see that the best performer there is the dark green line, which is the emerging market bonds over the past year. So emerging markets have benefited a lot from like we've heard in the earlier presentation, just from the dollar were falling relative to EMs over and above their local currency returns. Then if we just have our last slide in terms of the market and in terms of the global bond markets, on the left-hand side, just average government debt to GDP. You've got your EM, including China, is around 65. You've got your EM without China, that's below 60, which is what the developed markets, especially in Europe, are targeting as just appropriate debt over GDP. And then your DMs is well above 100. So that bit, is a source of risk, which we never know. Maybe it will take 10, it will take more years, or it will take an event for that risk to be exposed. But the reason why I'm just looking at this chart is to show the risk-reward ratio that we are seeing between emerging market bonds and your developed market bonds. So the chart on the right now tries to put the gross debt to GDP, that's unfunded, excluding unfunded liabilities for DM, and that's on your x-axis, sorry. So this is the debt to GDP on your right, the more it is, the more, I mean, risk in terms of the economy failing to pay, or for the economy to try and print money to pay off that debt. And then on the on the vertical axis, that's the reward for holding debt, which is your real yield, your 10-year bond, and subtract that with the forward 12-month forward CPI. So you'll find the line, economy is below the line. That means the risk is not being rewarded, and the economy is above the line. The risk is being rewarded. So you'll find that your Brazils, your emerging markets, South Africa, Brazil, your Egypt's, there is risk, but it seems as if that's already priced in the yield premium. And then with the emerging market, the vulnerabilities in terms of high GDP to debt to GDP, the compensation is not wide enough. So that's the risk. We over and above the dollar falling further as a tailwind. The fact that the risks in EM, they seem to be priced appropriately in terms of the compensation that investors will get. But like I said, our approach is broad market indices, and we think the optimal way of getting exposure in markets is through global indices. Just from a South African investor's perspective, we in terms of our fund, we use the MSCI All Country World Index. Still, it's something that has got all the sectors that might not necessarily be in South Africa. And also, the main thing is that it's 64% of your 64% of it is still in the US. So that diversification, I think that's the element that matters now. We know the dollar is falling, but still, in terms of correlation, it's something that's still core in terms of the portfolio diversification, because of some industries that you don't necessarily get in South Africa. So how do we capture that? For us, we believe that the portable alpha strategy. Yes, Eugene.
Funnel, we're going to have to round off with this slide. Sorry, we're very much out of time.
Okay, that's fine. We believe in a portable alpha strategy where we cash plus just total return, future or total return swap should give us index returns. But instead of enhancing using stock picking, we use the cash as our source of alpha. And if you use cash and still combine it with future or total return swap, we should be able to give to have an alpha over and above the MSCI. And the way the structure, the fund is structured at the moment, it has 100% exposure to the MSCI All Country World Index, and with a kick of 1.45 basis, 1.45%. I don't know if I can have a minute, Eugene, just to go through one more slide.
No.
Okay.
No, fine.
Thank you so much.
I'm going to have to pause you there. This is very insightful. You've got a ton of information in your slides. And like I said, we are going to share the slides with the audience. The one slide that I found particularly interesting is on bonds, with the US bonds right at the bottom from a risk-adjusted reward perspective. And we are going to have you on future sessions to unpack the workings of the fund a little bit more, because I think we do need to spend proper time on that instead of rushing through that. But Funnel, thank you very much for your time this morning. We are grateful. Thank you.
Thank you, Eugene.
It's my pleasure now to welcome a formidable fund manager in the industry for a very long time, Tony Bell from ThinkCell, and here to share his views on global macro outlook and the positioning of the MyPlan BCI Global Macro Fund. Tony, apologies for keeping you at the wait, but really looking forward to your presentation.
Thank you, Eugene. Cool, perfect. Good morning, everyone. Thank you very much for your time and interesting previous presenters. What I'm going to do, Eugene, in the interest of time, is just really consolidate your three previous speakers and factor that into our macro view. so I should be able to make up some time for you. The agenda is very brief. We've had the pleasure of running the MyPlan BCI Global Macro Fund for over 10 years now, a suite of other funds in the same product group. And I thought what I would do today, just to look to add some value for the viewers, is really to take a look at consensus and dig a little bit deeper and see where we might go with this year, and then share with you our current positioning. The fund has had an enviable track record. We started on the 13th of March 2013. It's realized about 15.3% compound return per annum. That's the blue line, the benchmark, the red line. And so what we're looking for in the management of this global flexible product, where we have an 80-20 benchmark, 80% MSCI, and depending on the product specification, 15% dollars and 5% cash, is a degree of flexibility where we capture the upside. We've got high upside capture ratio, but we aggressively manage the downside. And I think all of us have been through enough bumpy periods to appreciate that the downside is as important as capturing the upside. And we're very proud of that. So from a scoreboard, as they often comment in golf, there's no room for a comments column here. The numbers do speak for themselves. We're also very proud of the fact that the 3 funds that we run in this group have collectively won 12 Raging Bulls and 2 of the inaugural Fund Hub Awards. So enough of performance, Eugene. Let's get on to the main topic. I think if you look at the consensus that's been set out today, and Matthew did an excellent presentation, is that the consensus is very much about things will end in 2026 on a far better note. Matthew covered earnings growth, 15%, Kevin Walsh's appointment, there's consensus around dollar weakness. The previous speaker spoke extensively about liquidity being supplied into the system, and I think all of that's good. We don't need to laundry list the entire list. I think the objective of today's presentation really is to set a framework and look at where things could start to move in different directions and what the implication would be for everyone on the call, including the way in which we have positioned the portfolio. So where we are at the moment is over here. It's a nice sweet spot. Volatility is low. And as the previous speaker indicated, fiscal conditions are very easy, and that has put us into the growth quadrant. And really what we're looking for is, do we have a probability of moving more into a contractionary phase, which is not consensus at the moment? And dare I mention it, the R word up in the top right. So the thing that I observed through time, and I think I've been through about 8 or 9 bear markets, is they all tend to start to follow a pattern. There's a lot of breadth in the peaking. We hear about the market in the US expanding, but I think this chart is very interesting. And what it shows is that for every block on each of the indices, it's where that index sequentially hit new highs. Gold, of course, is in focus at the moment. And certainly the picture you can see is that there has been a very broad base of application or investment of that surplus liquidity that's been generated and significant highs in many new markets. So why are we slightly cautious? We look at the S&P, we look at earnings revisions, we see the consensus, yes. But if you break the consensus down, the Magnificent 7 top 10 account for about 20% in growth of the 15, and the rest of the market, the 490 stocks, are only expected to grow earnings at around 10% for the next 3 quarters, picking up a little bit into the fourth quarter as stimulus comes through. So just a concern around the concentration of earnings. These top 10 companies now account for 36% of the earnings base of the S&P and about 40% on the market cap. And I think Matthew did a really good job of unpacking some of the concerns around circularity, and we share those concerns. This chart worries us the most. The previous presenter did allude to it, the shape of the US bond market. So here's the question to pose to the audience and for you to think about. If US inflation is not a problem, and indeed the inflation break even suggests that forward inflation 5-10 years from now is about 2.5%. Why is the long end trading at 4.75? And why is the yield curve so steep? Ordinarily, yield curves are steep when economies are contracting. Central banks are cutting interest rates to try and stimulate demand, and they're cutting interest rates to try and promote job growth. This is an unusual picture. We've got the US economy almost on full tilt, and yet the yield curve is steep. And what it suggests to us is that there's term premium and funding risk at the long end. Trump is adding 3 trillion, covered previously, and that'll push by 2030 the US debt to GDP ratio up to about 140%. That's quite punchy. Do we get to a point where Walsh has to consider yield curve control, or is there some other form of monetization of US debt through something like stablecoin, perhaps a topic for another day? So the long end of the bond market worries us a little bit because that's where long duration assets like growth equities are priced. The other warning sign we see is the gold and Bitcoin. And just to dispel the myth, gold price rise has not been because central banks have been buying. The rise in the gold price has been because there has been a singular switch out of the dollar into gold. It's investment diversification. About 2% of US asset managers have switched their assets out of, US asset managers have switched about 2% of their assets out of dollars into gold. And I think what we're seeing in the last week with the contraction in the gold price, as I'll show you on the next chart, is short covering in the dollar space. But Bitcoin worries us. Bitcoin for us is a little bit of a proxy of liquidity. And so what we're looking for in our sort of macro thematic argument is, do we have liquidity coming into this market to support valuations underpinned by earnings, or is the confluence events likely to create tighter liquidity conditions, and that could be problematic for financial markets going forward? So here you see the dollar weakening, the green line, and you see what was a position from being long the dollar to short the dollar now covering in. And our sense of it is that market participants have started to close that trade with Walsh's appointment. I don't believe Walsh cuts interest rates as dramatically as the market expects. He's a very competent nominee. And I think we're going to see, along with Besant, more of a move from Wall Street and liquidity for financial assets to Main Street. That's the main thesis that the two gentlemen would follow, and that might be net negative for liquidity in the system. The other liquidity driver is very much the yen and the bond market in Japan. And one worries a little bit there because, to the extent that the Japanese have lost control of their financial destiny, you can see that similarly the market for a very short period of time went long the yen and now back into shorting the yen. And the implication there is you could start to have additional stress risk on Japanese bonds, a withdrawal of Japanese investors in the US bond market. If you look at the US bond market total debt, roughly 20% of the total market is held by foreigners, either in a public or private capacity. And if we start to find that there's pressure on those institutions to withdraw their money from the US bond market, it could put further pressure on the long end. So we've done a little bit of work where we've constructed an indicator that looks at the rate of change of global liquidity. And the simple explanation here is that we would prefer to see an environment where there is more accommodation capacity in the system than there is at the moment, And we think that much of this accommodation has already happened, as was shown in the previous presentation last year. So we're a bit worried about tightening tightening financial conditions in a market that sits with high valuation levels. Just moving into the closing few slides, Eugene. I thought this graph was quite eloquent. I have been in the market since around the 87 crash, so these are real world experiences for me. And I think the FANG stocks are put into context. It's not a chart to scare you, it's really a chart to create some perspective. FANG stocks have had incredible earnings growth. It's a cycle of reinvention that we haven't seen for a while, but it's also a cautionary that we do have very elevated levels with a very high level of dependency on certain companies, their ability to convert this capital, which is now 80% of their operating expenditure, the free cash flow, into a return to shareholders. So what we see happening in the market is we're starting to see this sort of series of toppings out. Stocks that were doing very well in the early part of the last few years have definitely started to come below the line. Meta, Microsoft had a dismal return. And I think what we're picking up in the fundamental analysis that concerns us with companies like Nvidia, Microsoft, is the circularity issue. It's been covered, but the stress on free cash flow. And to the extent that companies are now pretty much all in with $500 billion plus committed to data centers where the adoption rate is not yet 100% certain, and only specific to certain industries, we do worry about the productivity gains and whether those will come through fully into earnings to reward shareholders for the current valuation levels. So we see a world where there is going to be leadership change. And last slide, we've seen part of that leadership change in the world of emerging markets. The chart over here shows you what our full portfolio positioning is. On the horizontal axis, we look at how much risk we're taking. On the vertical axis, our active exposure. You will see the first point is that active exposure has been very carefully controlled because we feel the market potentially could get more volatile. And what we're doing in the dotted block is we have used gold very effectively, and our investment in Newmont and Barrick Gold to hedge out the risk of some of our gold exposure. We have diversified the portfolio more extensively into Asia, into Eurozone, into emerging markets. We've held a big chunk of the R2040 bond as a rand hedge and a yield pickup. We liquidated a fair portion of that about a week ago, very nice levels. And so now what we're doing is we're concentrating on those areas where we believe the earnings growth and the growth rate have high conviction calls, and we're managing risk around the rest. Eugene, in the interest of time, I will end on that and hand back to you.
Tony, thank you so much for bringing all of us together, always in a very calm and collected way. Interesting to see how you position your fund in mitigating some of these risks. You did speak to US bonds. Recently, we've seen a sell-off in US bonds. And, my sense is that it's China divorcing the US a little bit more, but gradually. But who's going to pick up the slack in US bonds? Because we know the Fed doesn't want to print more money. They don't want to buy the bonds. But could we see a stage where they're actually getting forced to start buying back more bonds,
Yes.
and then pushing the yields up further?
It's a lovely question, Eugene. Thank you for that. I think for those on the call that are interested, it's worth going into the background behind Walsh. He's got a very different take on life. And I think the short answer to your question is that they will start to change the reserve requirements of the US banking system. And that means that banks themselves will be the buyers of those bonds. and in fact they will substitute the Fed's typical buying under the old Powell model with a new model changing the reserve requirements for under the Walsh era. So it's worth doing a bit of background reading into Besant and Walsh. They think quite differently. They're very powerful intellects. And I think it's important to understand what levers they're going to pull in that regard.
Very interesting indeed. And Tony, thank you so much for coming on this morning. Really appreciate it. And always a good allocation to your fund if you're looking for good diversification in portfolios. You stood the test of time, and we see how experience plays a big role in managing global equity. Thank you so much.
Thank you very much.
Right, we're moving on, and no stranger to the audience is Rob Ollenman from Laurium Capital, appointed as the fund manager on the BCI MI Thornbridge Global Opportunities Feeder Fund. Big mouthful there, Rob. Rob, 2025 was another great year for you. How are you doing?
I'm very well, thanks. It's been, as you said, it was a good year last year, but January feels like it had 8 weeks in it. Every day another Trump tweet. So it's been an interesting start to the year, and certainly not plain sailing. Very good. So as we were just saying, the opening slide of my presentation, we manage the Thornbridge Fund. I represent Laurium Capital. It looks like it's been plain sailing, and last year was a good year for returns. I would say it's definitely an active investment environment. Active stock picking for us on the global equity side is going to be really important. Tony very nicely wrapped up that sort of macro environment, and I'll touch on that in a couple of my slides. But hopefully, the main message for me to investors today is to be wary of getting sucked into the noise and the kind of very strong daily narrative that seems to be driving decisions. We've seen a lot of volatility, not necessarily represented overall in index volatility by the VIX, but intra market volatility has been pretty strong. And I think you need to, as an investor, recognize that stick your strategies out for the long haul. So very briefly, I represent Laurium Capital. We are 17 years old as a business. We owner managers, boutique fund managers, largely institutional in our clients, but very happy to be appointed to manage the Thornbridge Global Opportunities Fund on the BCI platform, the South African Rand feeder into the Global Fund, which is a UK open-ended investment company. We've had nice success in kind of raising assets in the last couple of years, and managed just under $700 million in this fund and in another fund, which is very similar to that. Unconstrained stock pickers market, stock pickers fund, no specific geographic focus, and reasonably concentrated, 30 to 40 shares at our core. The fund signature over time, quality at a reasonable price. And that's very much, hopefully my presentation today will lead investors to understand exactly why we like to invest in the companies that we invested in. Strong companies, best place to thrive in an environment like this. Fund performance the last since we were appointed has been good. Last year was a really strong year for markets in absolute returns, but also from the fund perspective, we had nice outperformance over the last 12 months and over the last 2 years and the 3 years since appointment. Okay, so just a slide or two on content. What are we thinking? How are we responding as active fund managers? First of all, the investment backdrop has been very well summarized, as I mentioned. The Trump impact on the market, pretty well known. I think some of the negative impacts have yet to be felt. So initially, strong fiscal impulse is ongoing in the US and in other markets as well. The question is further down the line in terms of the fiscal debt situation, and I think that's pretty well articulated by what Tony was referencing just now. What's interesting to me is, previously I've had this slide up. I have it as a kind of a background, and I keep updating it from time to time for myself and for our team to make sure that we're covering all the really important top-down inputs into our market and our fund. I've always had foreign policy as kind of the least impactful on the real economy, on real company behavior. And keep in mind, we're investing in companies, and that's always something I remind myself of. But foreign policy this last month feels like it's been dominating the headlines so much that I think it's fair to say we've definitely felt we've had to think very carefully about some of the impacts on long-dated economic blocks, economic alliances, the European situation and some of the fiscal and defense impulse that comes through from that. Some of the relationships, even within North America, being challenged. And then obviously East-West relationships continue to be very tense and fraught. And so, two things that have arisen from that I think are really important. First of all, the price of money. Again, we always focus on the US yield curve. It's the denominator for valuing long-term dollar cash flows, and it's really important to think about the price of money for the dollar. I deliberately termed Donald Trump the walking yield curve steepener. He's desperate through this Fed policy shift to have interest rates lower. Certainly at the short end, that's the policy, that's the policy tool. But the upshot is, Eugene, as you just pointed out, obviously longer dated rates, the risk is that those steepen out and the term premium rises. And that's certainly in our expectation over time. It hasn't really happened just yet to any great extent. But I think this element and the dollar weakness that comes associated with that has been really important for us to think about. And the companies that we invest in has provided some opportunities. So interestingly, we have increased the exposure of the fund over the last 18 months into the financial sector. We invest typically in quality shares, high return shares, and banks don't always kind of meet the mark there. But it's really important from a portfolio construction perspective to expose investors to that opportunity. Banks typically borrow short and lend long, and so a kind of steeper environment like that provides longer term margins for banks. And indeed, we have seen that constantly upgrading expectations on interest income into the global banking system, both US and indeed in Europe. And then that's one opportunity. And then the second one is, I guess, an opportunity that there's more a sort of a hedging opportunity. Through geopolitical risk being elevated, we've invested a portion of the fund over this time as well in gold mining shares, which has been certainly helpful to returns over the last sort of 12 months. We have been trimming that exposure. Gold is starting to act much more pro-cyclically than negatively correlated as we would want it to be. A lot of this global tension has been expressed effectively in the bullion price, and has attracted that capital flight that we've seen. So it's been a beneficiary of this stress as we would want, but it is starting to become a bit more of a pro-cyclical environment, so we've reduced our exposure to that. And then there's lots of regional nuances. I'm not going to linger on each of these. I could spend 10 minutes on each, but China continues to be a tricky market. Lars did articulate some of the long-term structural opportunities there, but we don't buy sales, we buy profits, and the profits from many of these businesses are not being delivered in the same way as one might expect, given the tailwind of top line. Japan has been an interesting market with now Takaichi and the political uncertainty that we're seeing there, but still a lucrative market for us over time. And then also, this German fiscal boost, and in Korea, we've seen the semiconductor sector broaden out into some of the Korean companies. That's also been very beneficial for us and in the fund. But now that's the macro backdrop. Really important for us. We buy kind of profits in companies, as I said, that are designed to thrive in spite of the top down. We're looking for businesses which may have a real right to exist in the long term. Businesses with a very strong product set, service, that are very well managed, that have an element of pricing power where possible, that have strong cash flows, and that really can, work their own way through the volatility cycles that we see in the global economy. These are the areas that we've been focusing on in the recent past. This is the most lucrative area for us of stock picking. And then I'll show you how I bring that together in the overall fund as a coherent portfolio. And I always, constantly point out to investors, as a fund manager, global equity fund manager, you've got two big challenges. One, picking the right stocks by and large. Secondly, making a coherent portfolio out of that. And by that, I mean a portfolio that does take into account the fact that we're dealing in, at best, probabilities, not possibilities, and that we don't know what's going to happen. And so we always need to try and understand the known unknowns, the areas of the economy that we could be missing or that we are vulnerable to. So we think a lot about that in the overall portfolio. One of the areas that's been, the tech side of the trade, a lot of change, a lot of tailwinds, certainly for cloud migration and hardware upgrades. An area of the market that we've avoided typically in the recent, or certainly the last sort of couple of years, is the software and application space, and it's quite topical. In fact, overnight we saw a vomit in software share prices, with Anthropic coming out with a new agent, and the hardware side of technology investing is challenging enough. But currently we're really struggling to identify on the software and AI application side the winners and the commercialization opportunities that flow and will flow out of the industrial trends that we are seeing. So that focusing on where we feel we can gain conviction, that informs where the portfolio stock picking lies. The second area has been really, I think, an ongoing opportunity is in electrification and the power grid. That's both grid renewal as well as a rollout of data centers, and then tying in renewable energy sources, wind and solar and the like, through batteries and storage facilities, effectively into the curbside and into the data center. And we still see that there is significant industrial opportunity in that, profit opportunity, and that the market, although it's priced in a great deal of growth, is still struggling to price in the duration and the extent of that industrial opportunity. The stock market is a very efficient pricing machine, but when you've got all eyes focused on one way or the other, you do get opportunities, and it's in this area of change and rapid industrial change that I see the most opportunity for us as investors to gain, possibly an edge and mispricing. Pharma sector still provides us with opportunity, both cancer drugs as well as some of the weight loss drugs. Be a lot of news flow for investors today. You'll see the Novo Nordisk price down significantly after last night. We're not investors in Novo. We have been in the past, but are concerned on the pricing impacts that we see for the end consumer drug. But I would also point out, I think there's some big opportunities still coming in the pharmaceutical investment space going down the line. 2028 represents significant kind of genericization of patent drugs, certainly the biggest patent cliff that we've seen. And so we've managed to find a generic biosimilar company in there that we've been invested in that will benefit from some of these trends. And then on the industrialization, I've spoken about this power electrification story. The defense sector certainly was uninvestable, I would say, for responsible investors over a long period of time. I think that narrative has completely shifted and the reality of the situation has changed. And so we do invest to some extent in some of the defense companies, the European defense companies, particularly in Germany, that has quite a big fiscal push in this area. And the automation of the workplace also really interesting. I've spoken about the financial sector and the opportunities there, and then also in commodities, specifically precious metals, which have hedged some of these geopolitical risks. So these are all the areas of the fund that typically we have invested in more as positive opportunities. On the negative side, again, still remaining somewhat underexposed to consumer companies. The negative contributions in our fund still have been typically some of the beverage names. Heineken as a share that we've owned has underperformed over a longish period of time. And here it's some cyclical factors on the consumer spending. Certainly affordability and confidence is very fickle and fragile. But there's also these structural factors which are, I think, whittling away at some very long-dated business models, lifestyle moderation, all younger demographic, eating healthier, being healthier, avoiding, the worst excesses in some ways of, alcohol, tobacco, etc. And then the channel shift from buying goods, walking into a store to online, also that has some impacts on how marketing of specific products. As an example, in the beauty and cosmetics business, that channel shift has been very marked and certainly affects some of the commercial opportunities that we're seeing. So these are some of the areas that we've avoided. But interestingly, and I have made this point in the last couple of months, we have been finding a few more opportunities in this area where we feel that they are well priced, and the downside is much more limited than the potential upside down the line. And so we have started to rebuild some of our exposure in this area of the fund. The fund as a whole, this is kind of really the last important slide from me. I made the comment earlier on, stock picking is one challenge, portfolio construction is another, and I have a very simple way of thinking about the fund. We are co-investors. We want the portfolio to be full of winning companies that can compound and grind their way through industrial cycles and economic cycles, and not necessarily act as investors, as birds on the wire, flying in and flying out, and trying to get that timing right of being on the wire at the right time. So that's our job, is to have a strong core of the fund, which is, for me, it's always more than 60% of the fund in high-performing businesses with a right to survive and thrive, strong pricing power, strong financial health, good returns, well managed, with a product or service which is enduring and delivers cash and profits over time. We have always opportunities which come to us where we act a little bit like birds on the wire, where we think the market is pricing something wrong. These might be businesses which are not as financially healthy or in the right environment always. But we've done really well. We typically invest in best-in-class businesses in this area, as well as in this bottom left-hand quadrant, which is kind of what I call my rent part of the portfolio. Businesses with very low pricing power, but which are benefiting from these tailwinds, some of these macroeconomic tailwinds, or the thematic tailwinds, which I alluded to earlier on. A company like GE Vernova has been very, very good to us, continues to be a holding for us in the electrification space. So this is important for us to balance the portfolio from just this compounding, relatively well valued set of businesses to areas where we think the bulk of our returns comes from re-rating or excessive short-term growth, which is the bottom left-hand quadrant. From an overall picture perspective, the fund is represented right across sectors. I always make the point that sectoral allocation is not what we focus on. It just happens to be kind of after the event, a kind of look in the mirror test. But you can see we found opportunities in financials, in healthcare, in staples now increasingly, and underweight the technology sector, particularly the software sector. And then from a geographic perspective, we still find really good opportunities within US companies, and then a broad, diverse range of exposures. But the businesses that we're seeking out, typically, these are strong, large companies that operate not just in domestic markets, but across borders, and are able to exploit across borders as well. So I'll stop there, and happy to take some questions.
Rob, very insightful as usual, and finding us opportunities informed by real business trends. Maybe just a quick question, and I know it doesn't speak to your model, but we've had a couple of speakers, referring to the dollar being under pressure, and it appears as if the dollar is going to remain under pressure. When you allocate in your fund, because I mean you look at the whole world, entire world, we've seen your geographical allocation. Is currency something that pops up into a model saying, but I'm finding really good US companies, but what is the impact of currency going to do to my net returns?
It does influence the earnings of a number of companies that we look at. So what's the source of their cost of goods sold, the cost base, and where are the revenues in which jurisdiction? I'll give you just one very brief example. Recently, not recently, in fact, about 18 months ago, we switched our Visa holding into MasterCard. The view is that MasterCard earns more, these are businesses which scrape a small portion of a lot of transactions around the globe. MasterCard is better exposed to cash flows outside the US in a more diverse range of currencies. Also benefits a bit more from the kind of travel sector. And so, it was partly the thinking, Visa has made more dollars, MasterCard less dollars, just a small example. But, every company, particularly companies that make goods in the East and sell them in the West, those businesses, we have to think about the economics of those over a period of time. And the dollar, let's face it, has moved about 20% weaker, certainly against the euro over that time period, and against some of the Asian currencies as well. So it definitely does play a role. And we don't hedge that, we use that in our models.
AI has been a hype. Obviously, you spoke to AI as well. You made it clear that you are avoiding in the software space. Tony Bell and a couple of other presenters, previous presenters like Credo, also mentioned some of the concerns with regards to circular funding. Do you foresee that AI is maybe going to tip out at some point? Because, the CapEx spending is just massive, and there's a lack of evidence in how they're going to monetize it.
It's the $64,000 question.
That's why I give it to you, Rob.
I'm not as skeptical as some. I see a very big industrial shift from computing power sitting on everyone's desktop. We initially saw the data itself move into the cloud. That was early stages. Your photo album is now sitting in the cloud, Eugene. That's the good news and the bad news. But more than that, all of our data is moving into the cloud, and so cloud capacity will get kind of consumed. I'm pretty certain I'll underwrite that one. What is harder to see is whether the compute power, which is now moving into these data centers, from moving the brain effectively and the cardiovascular system for all processing into the cloud. That's a tougher question. At the moment, all indications are that these these facilities are still significantly demand constrained, not supply constrained, and so hence the reason why you're seeing an acceleration actually from all the big platform companies in that capex rollout. Some will be more vulnerable than others. I have the same feeling as I think that, one of the earlier speakers around Oracle, businesses which still have to monetize and have to earn the right to win, much more vulnerable to me than businesses which are large platform incumbents that have already significant platform incumbency. I think that the commercialization for the biggest companies, interestingly, is the biggest opportunity still. They have the user data, they have the data sets and the capacity in their hands. And I think over time that will be monetizable.
And again, finding a lot of those more sensible companies in your fund, your portfolio. Rob, thank you very much for your time this morning, and thank you for being patient with our timekeeping. I'm really grateful.
Thanks.
Right, for our last session, it's my absolute privilege to welcome no stranger to this audience as well, Simon Raubenheimer from Contrarius, all the way from Jersey. Simon, good morning. How are you?
Good morning, Eugene. I'm well, thank you. And thank you for having us, and thank you for saving the best for last.
I'm going to leave that with you, Simon, but maybe just before you start, I mean, similar to Rob, you smashed it in 2025. It was a massive year for you. Investors not invested. I mean, we're getting a lot of renewed interest in your fund, but I'm going to leave this with you, and maybe you can address it throughout your presentation. Some are asking if they're not buying you at a high now.
Hopefully not. No, thanks, Eugene. Let's maybe start with performance. We, as you can see on this slide here, we had a good 2025, and we generated these returns by holding a diversified portfolio without betting on any single factor or outcome. This is us in blue. You'll see our returns, and then we compare it to the MSCI World Index and the average global equity fund. And we showed over 1 year, 3 year, 5 years, 10 years since inception. Our biggest contributor over the last year was actually a classic sort of unloved value stock, namely Warner Brothers Discovery. And the market finally woke up to the value inherent in its rich content library and the upside in its streaming business. We also held a few Chinese companies, mainly Alibaba and Baidu. Those were cheap going into 2025, and those have contributed to our outperformance. And then the other notable performers that I think I would call out maybe were the memory and storage data businesses. So that would be Micron in the US and SK Hynix in South Korea. Those stocks did very, very well for us last year, and actually are still trading on very low earnings multiples. I think what was maybe significant for us in 2025 was that we didn't really have any major losers. So either the companies that lost money for us in the fund were small positions, or we managed to get out early without taking too much pain. I would lie if I said I wasn't happy about the fact that our performance is strong over all the time periods in this chart. But that said, this is a marathon, it's not a sprint. And we are firmly focused on that right-hand bar chart, namely how much value we add to our clients over the life of the fund. And that's what we'll continue working towards. The next slide shows a similar chart, but that's for our balanced fund. Our balanced fund has also done very well. It's small compared to our equity fund, but similarly, we are very pleased with our performance. So let's go on to the next slide, which is really sort of the framework of how we look at markets in 2026. We're trying to do 3 things. The first thing is we are trying to find the winners in AI. Now, that's easier said than done because things change so rapidly, and actually we change our minds quite frequently. And it's important to not get too wedded to any stocks or ideas. In this space of the market, there are pockets where valuations are very, very high, and there's a lot of optimism baked in. we've shown you a few examples of companies we've looked at there. Not all of those will be in our fund. This is just an illustration at a point in time. But that's sort of the first kind of area that we're trying to find value in. The second one in the middle there are the higher quality companies that are less likely to be disrupted by AI. Now, in that sort of basket of stocks are companies that previously would have been very popular with quality managers. They traded at incredibly high multiples. In many cases, those have come back down to earth. And this is, again, an example of some companies that we have or are looking at. Now, we don't own all of them, but it sort of gives you an idea of where we are starting to find more value. And then the third basket is those companies that may be disrupted by artificial intelligence. And this is perhaps even more important than those aforementioned baskets, and it doesn't get much airtime. It's very tricky, this space, because the valuations on many of these companies have already fallen a lot. But we still think there is a serious risk of buying into value traps here. And maybe sort of the most dangerous of these traps are companies that actually in the short term appear to be AI beneficiaries. So let's use software as a service as an example. They might be using AI to cut their costs. However, in many cases, they themselves are just an intermediary that will get disrupted or disintermediated when their clients use artificial intelligence to cut their own costs. So that's an area that we are trying to avoid. So if you move on to our top 10, the shares in our top 10 reflect our current views in line with the framework that I've just presented to you. I should add that this is a snapshot in time. In this case, it was the end of December 2025. And as I said previously, there has been some change to that as we update our views. Too often, actually, I see managers that are just stubbornly, sticking to the old paradigms and refusing to change. Our new sort of end of January top 10 is now up on our website. We put that up yesterday, so you can see the updated top 10 there. The one new position in our top 10 that I'll maybe call out and that I'll talk to today in more detail is EchoStar. It's our biggest share. I have talked to you about Tesla and Paramount at quite some detail before, so that's number 2 and 3. Oracle and Dell, you'll see in our top 10. Those are two founder-led IT infrastructure businesses. They are between 40 and 50% owned by their founders, Larry Ellison and Michael Dell, respectively, who are heavily incentivized to make it work. And their track record suggests to us that we certainly think it's better to back them than to bet against them. Oracle is the more controversial of the two. The market is worried about Oracle's debt levels and Oracle's exposure to OpenAI. Those concerns are not new. Everyone talks about it. Everyone writes about it. It's pretty consensus, and we think it's in the price. The share has already halved from its peak. Dell is on 11 times earnings. Micron and SK Hynix, which I mentioned before, both strong performers in 2025. Manufacturers of memory chips, those remain on very low. In fact, SK Hynix is on probably 7 times forward earnings. So they remain on very low multiples. Fox has been a great share for us. It's on 13 to 14 times normalized earnings, has a very dedicated following in the US, and management continue to execute well. Alphabet is also a share that most of you are familiar with. It's probably our least contrarian name, to be fair, but it's a great company at a reasonable price, so we continue to like it. And then Lululemon is a new stock in our top 10. It's again down probably 70% from its peak because of, I would say, management missteps, but we would think the brand value is not impaired. If we turn to the next slide, from a geographic point of view, we continue to have a large weighting towards US stocks, although we are somewhat below the benchmark. Despite, overall sort of, in the market, lots of people talking about high valuations for the US index as a whole. Remember, it's a very big, very diverse, very liquid market, and we are still finding a lot of value there. Our exposure to Europe has grown from very low levels. It's now 13% of the fund. And actually, our biggest overweight has been for a while Asia ex Japan. And that would be China, it would be Taiwan, it would be South Korea, where we are finding high quality and rapidly growing businesses at very reasonable valuations. By the way, when we construct the portfolio, we don't look at the benchmark weights at all. Every company is there on its own merit, irrespective of where it's listed. So if I turn to EchoStar, which is the company I'll talk to today, it's a very interesting company that we first invested in sort of late last year. The company started as a seller of satellite dishes out of the back of a pickup truck by a very entrepreneurial guy called Charlie Ergen. The company then started launching its own satellites and expanded into providing sort of wireless broadband and satellite TV to across the US. Last year, the company pivoted from being a capital-intensive holder of 5G spectrum to becoming a more asset-light investor in satellite technology by selling some of its spectrum, excess spectrum for cash, and also by selling some of it in return for shares in SpaceX. So this chart shows you where EchoStar is upon the conclusion of all those transactions. This was at the end of December, and you can see that EchoStar's stake in SpaceX plus the net cash that it now has was worth more than its market cap. And in addition to those assets, you've also got a whole bunch of other businesses, which include pay TV businesses like Dish. It's got Sling. You've got wireless and broadband businesses that we think are worth sort of in the high $60 a share. You're getting those remaining businesses completely for free. But the real upside to EchoStar's valuation is actually in SpaceX. And in putting this chart together, we used SpaceX's latest private market valuation, which was in December of 2025. So let's just talk about SpaceX for a minute or two. So the next slide, SpaceX really sort of revolutionized space travel by being the first to reuse their rockets. Dan, if we can turn to the next slide, please. And so reusing rockets has been a complete game changer for SpaceX. Just imagine British Airways had to sort of scrap their plane after every flight. In 2025, out of the 165 of SpaceX's Falcon 9 rocket launches, nearly all of those were redone with reusable rockets. Now, I mean, this is the very cutting edge of human ingenuity. I remember being absolutely blown away when I first watched the video of SpaceX catching its booster rocket, which is 70 meters high. That's like 23 stories. Okay, and that's a 23-story building that effectively has just fallen back from space to Earth, and they caught it with effectively a pair of chopsticks. This was back in 2024, I think. My kids and I, we watched that video many times over. And this chart here shows you just how big SpaceX lead on the competition is. Of the 616 tons of mass that was launched into space in the third quarter of 2025, SpaceX accounted for sort of 512 of those tons. No one else is even close. The next slide shows you just how transformative reusing rockets is. And so what this slide does is it charts the progress over the past 60 years. On the y-axis there, the cost per kilogram launched into space. And you can see how sort of costs have slowly come down over time, but really sort of SpaceX completely upended that trajectory in the late teens and basically revolutionized the industry. And I mean, I think that sort of logarithmic chart actually hides just the extent by sort of how much costs have fallen by. So you've gone from sort of $10,000 per kilogram launched into space to kind of 100 now, and it's it's going to fall by probably another factor of 10, and this is opening up a world of opportunity now for humanity to start doing things in space that you would previously have thought was science fiction, and we're only starting to scratch the surface of what's possible. SpaceX also has another subsidiary called Starlink. So that's the next slide. And what Starlink has done is Starlink has deployed thousands. Starlink now has, I think, almost 10,000, 9,800 rockets. 9,800 low Earth orbit satellites. And so they've created a satellite constellation which provides affordable, seamless, high-speed internet to basically every corner of the world, irrespective of how remote you are. And you can see here the customer growth. So the number of Starlink customers is parabolic. In fact, I've got several friends and in fact a few colleagues who are customers. And the ability to use high-speed broadband anywhere in the world is pretty incredible. So at the moment, you need a sort of a Starlink antenna. You actually get quite a nice sort of laptop-sized portable one that you can take with you. But increasingly, Starlink will partner with existing cellular carriers to provide remote high-speed internet access directly to your phone. So Starlink, for example, and T-Mobile already have a partnership whereby for an extra fee, T-Mobile clients can access Starlink's data directly to your phone without having to carry the extra antenna. And my guess is that this direct-to-phone business is Starlink's most exciting growth opportunity. Now, EchoStar bought its stake in SpaceX for effectively $400 billion last year. At the end of December, SpaceX was valued at $800 billion. It's in the most recent transaction between SpaceX and XAI. It looks like the valuation was around about $1 trillion. And we think it will list this year at a valuation that is even substantially higher than that. So we think there's quite a bit of upside to EchoStar's valuation. So on the next slide, I think that's us. In summary, we are optimistic. We are still finding great investment opportunities. Our portfolio composition hopefully protects us from falling victim to change and to disruption and to obsolescence, whilst sort of at the same time benefiting from the growth and the adoption of new technologies. And we hope to do so in a sort of a contrarian way. So that's it from my side. I'm happy to take any questions, Eugene.
Simon, very insightful indeed. 2 questions from the audience. I'm going to start with Tesla because it's always been one of your more favorite shares. And the question is, has your views on Tesla shifted after the autonomous driving disappointment?
Yeah, after the
autonomous driving disappointment.
We certainly think autonomous driving is growing in leaps and bounds. We think Tesla is ahead of their competition. Remember, and we've spoken about this in the past, Tesla's approach is completely different to a Waymo's, for example. We think the company is very cautious in rolling out FSD. So initially, you had safety drivers sit in the car. They've now removed those safety drivers. And if you go to Austin or to San Francisco now, the cars are driving around fully autonomously without a safety driver in the seat. I'm actually quite happy with the slow rollout because if there were any incidences or whatever, it would create like incredibly bad press. We think Tesla's autonomous cars are already safer than human drivers. And there are some statistics and things that we track that demonstrate that. So we think Tesla is, I still think autonomous driving, or FSD, is probably the first real world test case of artificial intelligence. I mean, this is a robot that effectively sees its environment and responds to what it sees. It trains itself to get better. It keeps getting better with time. The latest releases of FSD, keep improving on previous iterations. So we think the company is very, very much on the right track.
Yeah, and I think that is the concern. It's this massive slow take-up from investors in Tesla and users is taking up on autonomous driving. But time will tell. I tend to agree with you. They're ahead of that, but we'll see how they proceed. A question from Dean on Oracle. We've had a couple of presenters commenting on Oracle as well. We've heard lots of comments on circular financing and all these kind of things. What's your investment case of Oracle?
Yeah, so I mean, all the concerns around Oracle are not new. I mean, they're partly, in fact, we think they're fully reflected in the share price. Oracle's share has halved from its peak, and we actually think Oracle continues to be one of the beneficiaries of AI. To some extent, you are backing management. So we think, Larry Ellison has an unbelievable track record, not sort of flash in the pan. He's built a massive business over many decades. And on our numbers, we think Oracle won't run into any funding issues. You saw most recently they had no issues selling convertible bonds, raising debt at very reasonable rates. We think, again, OpenAI, which is a big customer of Oracle, Oracle's sort of order book is $550 billion, of which, let's say, OpenAI is maybe half or so of that, maybe just over half. OpenAI also doesn't seem to have any issues raising funding, certainly in the near to medium term. AI adoption continues to grow and to grow rapidly. And on our numbers, we think we're actually quite optimistic on Oracle. We think earnings are going to grow fairly strongly. Of course, the leverage provides that sort of additional kicker, also provides risk should it not go right. But on our numbers, you're paying a low 20s multiple at Oracle, and for Oracle at the moment, for a company that we think can grow by 25 to 30% compound over the next 4 to 5 years. And we on our numbers, the funding is not an issue.
Interesting indeed.
We can change our mind on this. We can change our mind on this quite quickly. I mean, these are very liquid, very deep shares. If something comes out that we don't like, we can be out in a matter of minutes.
Interesting to see what companies you had, and Warner Brothers was indeed a very good example. We got nervous about that share about a year and a half ago, and it finally paid off. So you were right on the stocks, as many other stocks in your portfolio. Finally, exactly. Very, very last question. I know this offshore webinar, but you recently launched local funds as well, including a balanced fund. Just want to test your asset allocation views, your global exposure in your balanced fund at the moment. What is that sitting at, more or less?
Oh, I mean, so on the global side, we're still near the sort of 40% that we can be.
Okay.
I'd say high 30s. I mean, we also think South African assets are attractive. We are finding great opportunities globally, but we are similarly optimistic about many of the South African shares. We find a lot of the resources names. I mean, the market has been strong, but valuations are still very, very attractive in South Africa. An area that we are underweight would be bonds. So we'd be overweight equities. So a full allocation to offshore equities, a reasonable allocation to South African equities, and then a low allocation to bonds. And then we still have a little bit of gold and actually a little bit of silver. So that's physical gold and physical silver in the balanced fund as well.
It's naughty of me to sneak that in, but thank you very much for giving your perspectives on that. Simon, always great to have you on these sessions, and thank you for the good work you're doing.
Great.
For
thank you very
clients.
much, Eugene.
Thank you so much.
Thank you. Cheers. Bye-bye. Bye.
Yeah, audience, again, thank you very much for your patience. We ran over time significantly, but I think it was very insightful. The last three presenters, I think, did a fantastic job in summarizing exactly where we are. And yes, we will be sharing the recording. So if you want to go look at some of the comments again, I most certainly are going to look at one of the presentations again. It was very insightful. To the BCI team, thank you so much. And then we're looking forward and seeing you all in our upcoming roadshows that starts next week, the 10th of February in Johannesburg, and finishing off in PE on the 18th of February. Looking forward to seeing you all there, and have a fantastic week further. Thank you so much.